Hi there, it's Heather from BMO Healthcare. Why do I support pharmacy in Phlux? Because they support pharmacists. Your pharmacist helps you find over-the-counter medications, answers your COVID questions, provides essential services without the same recognition as other healthcare providers, partners with your doctor to change or adjust your medications, delivers information and classes on diabetes, heart health, high blood pressure, and more, and gives flu shots while you take 5 minutes out of your shopping. So why do I support pharmacy in Phlux? Because they support pharmacists. And everybody knows pharmacists are faster than a speeding COVID droplet, more powerful than a raging flu, able to leap tall counters to give a naloxone shot during the opioid crisis. Because pharmacists, you are healthcare heroes, a vital part of the health and well-being of this great nation. Stay tuned for more Pharmacy in Phlux episodes with key people talking about relevant industry information. And like Pharmacy in Phlux, BMO is here to help. Ask me about BMO for pharmacists. I'm available at 604-354-4989 or email me at heather.yuzik@bmo.com.
Hello, everybody, and welcome to this episode of Pharmacy in Phlux. We're really excited about our guest today. And before we get to that, we are your hosts. I'm Derek DeRosie, and along with my co-host, Phil Hauser, and we're happy to have you back tuning into this episode. Our guest today is Heather Yuzik, who you just met in the intro to this episode. Heather is the Regional Market Leader of Healthcare and the Director of Business Development for Healthcare at BMO Bank of Montreal. Heather's been with BMO for 10 years, providing solutions to the healthcare industry in BC. She's been visible in her presence at the pharmacy community, through various webinars, social media, and guest lectures at UBC, and she is well known in the healthcare industry circles. And so without any further ado, we'd like to welcome you, Heather, and we really look forward to getting into a discussion about financing, in particular financing for pharmacy acquisitions today, and exploring some of those issues. So welcome aboard.
My pleasure.
All right, so let's get going. We've got a number of topics to cover in this episode, and I think we're going to kind of try to jump around. And there's not necessarily a natural flow to these, and I think that's just the nature of some of the things that we want to cover. But we've got a lot of things that we want to touch on. So with that, I'm going to turn it over to Phil to pose our first question to you to get into our discussion for today, and we'll take it from there. Go ahead there, Phil.
Great to have you, Heather. What kind of documentation packages the bank typically look for when a buyer is applying for financing for a pharmacy purchase?
So the typical documents that we would request would be 3 years of financial statements for the subject pharmacy. The 3 years because we're looking to see the trend. A business plan with projections would be very beneficial. Personal financial statement, and that can be obtained from the borrower's bank. Each bank has their own individual statement, so they'll need their own statement signed. And a completed BMO questionnaire. We've put together a questionnaire as part of our program that has items such as percentage of ownership, top referring MDs, number of scripts, various information collected in one place. These are the key items we would look for, but there may be a request for further information. And of course, we would have an interview with the person so that we can ask questions and find out what their particular needs are, their short-term plans and their long-term plans.
So Heather, in that response, you touched on something that's sort of near and dear to our hearts, and that's the whole idea of a written business plan and pro forma financial. And so can you elaborate on that a little bit and sort of tell us a little bit about how important that is? And we really want to, I think, drive home to our viewers that those are important components.
Yeah, for sure. The reason a business plan is so important is because it lays out the changes that the buyer is planning to make. It shows the bank that they have done their due diligence, that they've thought through the plan, and that they understand the market that they're in. We would want to see things like short-term and long-term plans, current and new revenue streams, staffing changes, demographics in the neighborhood, their marketing plan, current and future equipment and software upgrades, purchases, and of course, right now, COVID protocols and upgrades that are already made, and maybe further ones that they would be planning to make just in this COVID period. So a business plan is vital for a startup. It's pretty much mandatory, but it's also important for an acquisition because it gives the bank insights.
So
Heather, can
let
I
me just
just do a
elaborate on
follow-up?
that a
Sorry.
bit. Oh, sorry, Phil, go ahead.
I just want, excuse me, I just wanted to ask the question. How often do you see business plans come to you for first-time buyers? Is it a common occurrence? Is it rare? What does that look like?
Um, it's we see them quite often, and they're really all over the map as far as the details. And I guess they're as individual as the people that bring them, really. Sometimes it can be very high level, and sometimes very in depth. So and sometimes people will attempt to put them together themselves, but of course that takes a lot of time. It's if they get somebody in to help them, they can give the information and get it processed in a way that's very readable for the bank. But again, it depends on the purchaser.
Yeah, that makes a lot of sense. I know why Phil asked the question because in our experience, a lot of first-time buyers are pretty ill-equipped and not really well prepared to approach the bank, and we have to do a lot of coaching around this issue of developing a proper business plan and people having some foresight and thought about where they want to go and how they're going to get there. And maybe just before we leave this business plan issue, one more sort of add on to that is the question around um, a startup versus somebody who's got an established business and it's not an acquisition, but they're coming to the bank for some money to do something in the business, a major renovation or a major change in the business, upgrading a POS system. Is a business plan still important even for those kind of folks?
It's always helpful. I mean, the more information that they can bring to the bank is to their benefit, because in the banking world, um, risk is equated as the unknown. So the more that we know, of course, the better position we're in to make those decisions. So, and I should qualify what I said earlier about the business plans and new buyers. I sometimes have to ask them to come back with a business plan. They don't always come equipped with the business plan, but by the time we're done, we have it.
Yeah. Okay, that's good.
So, Heather, what are the top 3 or 4 KPIs or key performance indicators that the bank looks at when assessing a potential acquisition?
So the top KPI that the bank focuses on, as you would imagine, would be cash flow. That is the main thing, but because of course that's what services our loan. And so we're not as interested in the um, details of where that cash comes from, although that is important. We look at it, but the ultimate test for us is there enough cash flow to service this debt? So that is the main focus. After that, I would say that these would be um, key elements. So not necessarily performance indicators, but definitely key elements. So we would look at experience of the buyer, because of course, the more years of experience the buyer has, it tells us the more they've seen. They've seen a pharmacy owner deal with staffing issues, with economic downturns, with challenges like COVID, various things, and they've seen what's worked and what's not worked. So experience a very important driver as far as risk goes for the bank. And Also, I would say personal net worth would weigh in because, of course, that's part of the strength of the overall deal.
So let me build on that a little bit, Heather, with a couple of follow-ups here. The first one is regard to the whole idea of personal net worth and a personal statement, as you outlined as one of the requirements. Is a personal guarantee, or I'm not sure if I'm using the right terminology from the finance perspective. Is that something that the bank's going to insist upon for a loan?
Yes, it's very rare that we would not take a personal guarantee no matter what the loan is. Sometimes, if there's a very strong corporation, there may be a structure in place that would take corporate guarantees, and that would be sufficient. But each situation is unique, and so I could never say that anything is definite because at BMO we're not a cookie cutter bank. We lay everything on the table and we take everything into consideration and structure a loan that is in the best interest of all the parties as much as possible. But I would say that 99% of the time, yes, we would want a personal guarantee.
So let me come back to that issue as well in your answer before the discussion about the person. You referenced experience of the person as well as a factor that might be considered by the bank. Does it make a difference to the bank, and we're talking specifically with pharmacy here, if the applicant is an actual pharmacist, licensed pharmacist, versus a non-pharmacist owner? And I ask that from the perspective of uh, it would seem that the bank might take more comfort if the person was a pharmacist, knowing that if things were going south a little bit, they could actually really step in and, for example, reduce salary and wage expenses by taking a lot of shifts behind the dispensary and not having to pay another pharmacist to do that, or those kind of things. Does that matter?
Yes, that's exactly right. The pharmacist owner is viewed as lower risk for that very reason, because they can always step in on the operations. So even though they may have the pharmacy run by staff pharmacists, they can always step in. Where a non-pharmacist owner, they're limited. They need to provide the staff to run the pharmacy. So even though a non-pharmacist owner can be successful, they have a higher cost structure because they're, of course, drawing their dividends and owner compensation also out of the cash flow and paying staff pharmacists as well.
Yeah, makes a lot of sense. Thanks.
So what kind of expectation does the bank have for ongoing reporting during the term of the loan? Is that something that you expect on a quarterly basis, biannual, annual? What does that look like?
I would say, well, the bank, first of all, the bank is subject to regulatory parameters. And at minimum, we would need to do an annual review. And that's what we mostly see. Although, again, each situation is individual. And so if, say, a pharmacy was running into some problems, then we may feel that it's in everybody's best interest to monitor quarterly and get quarterly reporting. If things are really difficult, we may even go to monthly, though I think that's not that usual. So what I've seen most of the time is annual. And what we would do is we would request of course, a copy of the most recent financial statements, the tax return for the company, notice of assessment, and they would sign off just on an internal form to say that all of their government remittances are up to date.
Would that be typically different for a startup versus an acquisition in terms of the reporting? In other words, startup required to have more reporting than an acquisition?
Not necessarily more reporting. I think it's the same, but maybe more conversation. So banking is as much about relationships as it is about the actual transaction.
Mm.
And we look to build strong relationships so that we know what's going on. Sometimes people have a tendency to want to hide things from the bank. If things aren't going well, they want to cover it up. But in actual fact, by being transparent and upfront and having that good relationship with your relationship manager, then it's good because it's caught early on, and the bank can come in and support, maybe through, in some cases, a restructure, or bringing in other parties or suggesting other parties that can come in and provide that support. Because of course we have a broad view over the industry, and we know a lot of the players, and so that's one area we can come in and be a support.
So let me build on that again a little bit, Heather. And I think you've hit on some really great points here, and maybe we should build on this stuff a little bit more. But one of the things, which is a very specific question I want to ask you, is if things are going south in a business that you financed, what, in addition to perhaps more frequent reporting, what other steps a bank take uh, without actually calling the entire loan? So, for example, would you find yourself in a situation of saying to the owner, well, we need more reporting, but and also you stop taking dividends for the next X number of months or something like that?
Well, the bank always wants to work with the pharmacy owner or whatever business it is to create the best possible scenario. So we do have a special accounts unit that, sometimes the account manager will manage the relationship for a time. Sometimes it's transferred into our special accounts unit, and more support is provided. But yeah, they would look at different things. They would look at how much the borrower needs to take to support their personal obligations. And of course, that varies because there's a spouse involved often, and they're bringing in an income sometimes. And so it's really laying everything out, looking at the whole scenario, what needs to happen, what's a want, what's a must, and then creating a structure that works, that wins. So it's always in the bank's best interest to support the business owner, to get them back on their feet and successful. That then everybody wins, and that's really what the goal ultimately is.
Great, great. Phil?
Um, what is the loan to value ratio that the bank will lend to? Are we talking 75, 85%? What does that look like typically?
So that would look like up to 90% of goodwill, and that's based on an internal calculation that we do at the bank here. 90%, up to 90% of goodwill, and up to 100% of inventory financing. So again, every situation is unique. And so we lay everything on the table. And some deals are stronger and some deals are less strong. That plays into the overall structure. So even though we have a program and it has parameters, we ultimately do a deal that makes sense. So I've seen structures that are a little bit less, where it's 80% financing of goodwill, and I've seen 100% financing in extremely strong deals. And also, I
Okay,
should
that's
say, uh, in that vein, that we also offer, get my mouth around those words, we also offer an operating line and a term loan for the pharmacy purchase, and leasehold improvement loans, a corporate MasterCard for daily expenses, and we finance real estate.
good. That's
Good to
great to
know.
know. I mean, that was really good information. And I think a lot of folks who are thinking about getting into ownership, are concerned about how much of a down payment they're going to need, so to speak, or how much of their own savings they're going to have to expend on the acquisition versus, how much can they borrow from the bank. And I think you've just told us that, depending on the strength of the deal, there's an opportunity to borrow a lot of the total purchase price, as long as all the other parameters are there. So let's shift gears a little bit for a few minutes here and talk a little bit about the whole valuation business, the idea of evaluation, and how the bank might value a business versus and comparing that to what the person has agreed to pay for the business versus potentially an external independent valuation. So let me start that by asking if an applicant shows up at the bank and has already had an independent business valuation done, is the bank willing to take that into consideration, or is the bank going to go through its own valuation process regardless of what that independent valuation might say?
Well, I would say yes and yes. The bank does take it into consideration, but also the bank will always do their own valuation. And the reason for that is the bank's valuation internally is for lending purposes, not to place the same, it's not for the same purpose like of market value. Whereas a third party valuation then gives us evidence of market value. So it's important to note that the bank is making an assessment of cash flow produced by the pharmacy in relation to the loan payment. While the pharmacy may be valued at a specific dollar amount, the bank can only lend to the amount that the pharmacy can comfortably service the debt. So, but at the same time, the third party valuation supports the fallback position of the borrower. So, in terms of security, that's where it would come into play.
Just a
That makes a
follow-up
lot of
question.
sense.
Sorry, Derek. Just a follow-up comment. You mentioned earlier about financing for real estate, and Derek and I reasonably often run into deals where the seller will have own the property. So when a deal comes to you where there's an opportunity to finance not just the pharmacy acquisition but the property, what are you looking for in terms of value on the property? Are you looking at a third-party valuation from a commercial realtor? What does that look like?
We would almost always need an appraisal from a realtor, but again, there is that flexibility. The odd time, maybe we wouldn't need it, but I would say to make the assumption we would need the third party appraisal. So yeah, and again, then the telling parameter of something like that, where it's a real estate deal and a pharmacy acquisition, would be the cash flow. Does it support both loans?
Okay.
And if not, then how much can the borrower put in to bring
Hmm.
the loan down and make it doable?
Good to know.
So yeah, that's very good information for us and our listeners and viewers. Heather, let's just go back to the valuation thing again. Um, most independent valuations from an external third party, including RX ownership, we do valuations for people all the time, sort of based on what we see in the market, and we use a multiple of methodologies. But I mean, the most common methodology really that we're seeing now is a multiple of EBITDA. So, and just for listeners, I'm using the acronym EBITDA, earnings before interest, taxes, depreciation, and amortization. And so we see certain multiples of that in different markets, depending on whether it's a rural or an urban pharmacy and where it might be located, and a ton of other factors that might affect that, issues related to the lease, which I want to come to in a minute here and ask you some questions about leases and how the bank views that. But with the valuation, if you see a valuation as a multiple of EBITDA, and you knowing that that's what we're talking about, market value versus the bank's valuation in terms of cash flow, um, you know, they're obviously completely different methodologies because you're looking at a different parameter. And I guess this comes back in my mind. I guess this is really more by way of a comment, but I'm interested in your thoughts on it. Is that whole issue of whether the applicant's a pharmacist owner or a non-pharmacist owner, because you referenced the whole ability of a pharmacist owner to be able to step in and really that could improve cash flow significantly because they're now reducing the potential wage and benefit expense for other pharmacists. So from a valuation perspective, example of EBITDA, or is EBITDA itself, important to the bank, or is it really just mainly about that cash flow and the ability for the business to be able to service the loan through cash flow?
So when we do our internal valuation, we do a weighted average normalized EBITDA. So we are focused on that as well. But the way that we would come to that might be slightly different. We would typically, with valuations in several industries, you see items added back that we wouldn't add back, for instance, because your view is more when you're creating a valuation, it's to give the owner a sense of what is and what could be. And for the bank, it's always creating a very conservative view and a view of in relation to how risk would apply, if that makes sense. So we are
I think
focused
it,
on EBITDA.
yeah, it certainly does make sense, absolutely. And I mean, when we do EBITDA, and when we add back, for example, expenses, when we add them back to income in our normalization process, we're only adding back things that we view as one-offs, as one-time, potentially not recurring expenses. So if I'm looking at last year, here's a good example. I just did one for somebody fairly recently, and there was a computer expense on the expense line on the income statement. And I said, well, what's this for? And he said, well, I upgraded the computer system, and the accountants decided to put all the software expense as a one-time computer expense. Well, I'm adding that back in income. It's not going to occur again next year, right? So that's the way we would view things like that. And the same though, if there are extraordinary things in the income that might not be there, we're gonna take a look at that, and we're also going to add back expenses that a new owner might be incurring that the current owner might not. So, for example, if we've got a pharmacist selling a business to a non-pharmacist owner, we're going to add in an owner's draw as a new expense when in our normalization process, because the new owner is going to have to take some money out of the company for their own income. No, we're doing that we're taking a guess because we don't really know who that person is. This is just usually we're doing this in advance of knowing who the buyer or the seller is, depending on who's asking for the valuation. So let's jump back to, we want to come back to the leases because I mentioned, let's jump to the issue of goodwill. Now, you already mentioned this, but I don't know if you want to expand on it. And that's the whole idea of the bank financing goodwill. I think there's a mentality that exists out there in the professional world that banks won't finance goodwill because it's not a tangible thing. That's really not the case, certainly with BMO, is it?
No, and in fact, BMO was the first bank to understand pharmacy and create a pharmacy program. A lot of people don't know that. And to include a financing of goodwill component to that, because of course that's, that is a part of it. If you leave out the goodwill, then there's a lot that's not being financed. So yeah.
For sure.
Yeah. Yeah. Yeah.
So
The biggest
I
part.
have a question. I have a question, pertinent to that is goodwill for us in the pharmacy business is basically driven by the volume of prescriptions that a pharmacy will put through annually, and that can be significant in driving goodwill. Is that something that the bank recognizes, or do they look at goodwill differently?
We do look at it slightly differently, although we do take into account things like number of scripts, which would be captured in our questionnaire. So again, it comes back to the holistic view that we take. So we're doing several things. We're looking at the financial statements. We're doing our internal valuation. We're looking at who the buyer is, who the seller is, the number of scripts, who are the referring physicians. Where are they located? Is the buyer adding new revenue streams? So there's a lot that goes into the overall picture, not just one element. And I think it's very beneficial to the buyer, because if you're doing things in a cookie cutter way, then you're missing things. You're not taking in the reality of the situation and adjusting for it. And I found that BMO is over across the board very good for that. It's like part of our philosophy. It's part of the fabric of how we do things. As much as I don't know exactly how to explain it, except that we work so in such a close knit group, and everything is just, it makes sense. And using, seeing people as people, and being about the relationship, it really does affect how you do business. And that's one of the reasons that I really love working for BMO, because they really do, at the end of the day, care about people.
Excellent. So I have a follow-up question. You mentioned doctors, and this is something that Derek and I run into all the time, where pharmacies that are presented to us for sale will have doctors across the street, doctors next door. But now the big deal is to have doctors in sharing the same space. When you run into an opportunity where someone comes to you for a potential acquisition and they say, hey, we've got doctors sharing the same space, does it make a difference if those doctors have a separate lease or if they have some kind of agreement with the farm? How does that look in terms of you looking at that and calculating value with that kind of proximity with the script writers?
I think there's a lot of different combinations that people look at when they're dealing with MDs and pharmacy jointly in the same building. So one of the first things that we would say is, if the pharmacy is in partnership in some way with the MDs, we want to see some kind of contract with the MDs, and that they're going to stick around. Because
Okay.
with drop-in clinics, for instance, it is very difficult to keep doctors in drop-in clinics, it seems. And so you can get a lot of turnover and understaffing at times, and that impacts the number of scripts. So again, looking at it as an individual entity, each one on its own and unique, we would look at the strengths and weaknesses of that. If it's MDs who've been there for 20 years and they're going to be there another 20 years, yes, then it is very impactful, and it is very stabilizing.
That's good to know.
So that's
We run into. Sorry, Derek. I just wanted to say this follow-up comment. We run into more circumstances where pharmacies will actually have shared space with doctors with no agreement in place, and the turnover can be dramatic and shocking. We offer actually on our marketplace page a licensing agreement to try to encourage owners to get some kind of agreement in place with their doctors so that they're not shocked by a typical circumstance, which I've heard over and over again. A doctor will come to the owner on a Friday morning and say, hey, I'm moving out this weekend. I'm going somewhere else. Thank you very much. And they just go. And it's just, it sounds simple, but that happens quite often. And it's certainly something that we encourage owners and potential buyers to understand as something that needs to be dealt with for sure.
Yeah, I'm glad you raised that issue, Phil. It's a big one. We see it. It's happened over and over and over again for sure. And that's a really great segue to the whole thing I wanted to ask you about in regards to leases, Heather, and what the sort of bank's expectations are. And I'm asking this for a reason. We're seeing more and more these days issues where landlords are really not willing to go very long term on lease or lease renewal options. Lease assignments generally are still not a problem, but oftentimes, in the past we would recommend to the buyer that as part of the lease assignment, they sort of negotiate some new terms or at least some new renewal options with the landlord. And we're finding now that a lot of landlords even though there may not be a demolition clause per se in the lease, they're still saying, well, I might want to redevelop the property in 5 years. So I really don't want to give you a lease more than 3 years or 5 years. And I know the bank would really like to see a lot more long-term security in terms of a lease, and maybe saying, well, we want a 10-year lease. If the landlord's reticent to do that, is that going to dramatically affect the potential success of that application for a loan? Or, where are we with that situation with leases and terms?
The bank does want to see a lease with terms and renewals that equal the total amortization of the loan. It's difficult to work around a situation where there's a demo clause or not enough years that are basically guaranteed to the owner. It creates a significant risk. Having said that, it's not easy to do this, but there are times when when all the elements are there, when we can create, or we can look at a scenario where somebody would be forced to uproot early, and we can see that there's less risk in them moving, and that they would potentially be able to continue to make their loan payments. And so we have worked around it, but that's not a guarantee that we would be able to do it. It is a significant hurdle.
Yeah. Okay. Understandable. And that's why I asked that. I mean, I really want our viewers and listeners to know and understand that lease terms, are a significantly important factor, I think. And as you say, I mean, the shorter the years, then more likely the shorter the amortization on the loan has to be, which means the higher the payments have to be, and then it's a cash flow problem again, right? So
Yeah.
we've seen it all for sure, for sure. So we're sort of coming to where we've kind of covered a lot of stuff here. I'm going to ask Phil right now if he's got any really burning last questions that he wants to ask. And if not, we know we're going to do another episode with you and another guest. And maybe we can interject those then if Phil doesn't have anything else today. Phil?
No, I don't have anything else today. I think we've covered a lot for our viewers to kind of digest, and I would just encourage anyone listening who's been part of this presentation today to reach out to us via our website with any follow-up questions, or reach out to Heather directly to keep this conversation going. Because as Derek said, we've kind of jumped around and covered what we feel are important issues today, but there's certainly a lot more issues we could talk about, and certainly in broader terms of what we've talked about as well. So, yeah, give us a shout.
I just thought of one. Thanks, Phil. And I just thought of one thing that Heather, a really quickie before we wrap up here. And that's it. Does it matter to the bank if the applicant already is doing all their personal banking with the bank that they're applying to the loan, to have the loan for the business?
So that goes to relationship. So if we already have a relationship with the borrower, it does go a long ways because they're known. And again, what's unknown to the bank represents risk of certain levels. But if they're already known and they're with the bank, then we have a certain amount of visibility. So we can see that the relationship has been X number of years, they're in good standing. It tells us something. And it also goes to one other thing I should say, and that is that the stronger the relationship that the bank has with a borrower in terms of, their home mortgage or investments, commercial borrowings, the more discretion that we have to provide better rates and fee waivers and things like that, different perks. We're always looking for a full banking relationship. Plus, it's easier for the borrower because we have visibility. We can pull a lot of the information we need, and they don't have to go and gather as much up and give it to us.
Well, terrific. I think that's a really good place to wrap this one up. Thank you again, Heather. Heather from BMO for taking the time to be with us today and sharing all of those insights. And I hope that our viewers and listeners found that to be educational and thought stimulating. And as Phil said, please feel free to reach out to Heather directly or to us through our website, rxownership.ca. Thanks for tuning in to Pharmacy in Flux, and we'll see you next time.